All right, here with us now is Ryan Payne, the president of Payne Capital Management, to talk all things business and the markets. And Ryan, good to have you with us on this Friday night.
Always a pleasure, Michelle.
Ryan, markets were flat, just slipping into the red. Were you surprised by that reaction, considering what happened in Syria overnight?
I think it just shows you how resilient the markets are here, and that's something I've been saying a long time, that the fundamentals are so strong that even bad news, the market's basically ignoring it right now.
But are the markets too complacent? There is a lot of geopolitical uncertainty out there. The president has taken a military strike. We don't know what that could mean for potential action in North Korea. We're not seeing any of this we're not seeing investors really reacting to any of this.
Well, that's because you have to remember, too, this is the most hated bull market of all time. So there's not that many participants. We still have like $11 trillion on the sidelines. So, there's not that much money in the market. So I'm waiting for the day where all this money starts to find its way back into the market as opposed to panic out.
Well, expand on that.
Well, I mean, if you look at it over, the course since 2009 is when the market started to recover. Since then, the participation rate's been one of the lowest of all time. So what that says to me is this market probably has a lot longer to climb, because if you're at a top of a bull market, that's when people get really giddy. You have everybody participating, and then the end's pretty close. Right now, we have very, very negative sentiment. There's a lot of disbelief that the market's not going down, which is a very bullish sign.
So you think that's going to attract even more money and drive markets higher?
I do.
All right. Well, one thing that was up today was oil. Now, Syria is not a major producer or exporter of oil. So what's that about?
Well, I think just turmoil in the Middle East in general probably causes concern for production. But also, you have to remember, oil just had a big correction. You already dipped under $50 a barrel. So I think now you're starting to get the rebound from that correction.
Gold, that hit a 5-month high. Is this a flight to a safe haven, which is a typical move, or is there another explanation?
Well, I think the weaker dollar has a lot to do with it. A lot of commodities are bought in U.S. denomination, so when the dollar weakens, that's typically very good for commodities. Because for the most part, gold hasn't done very well the last couple of years. So I think it has more to do with our currency weakening than a real love for gold here. So
it's not about investors looking for that safe haven, which gold typically is, because they're concerned about the geopolitical tensions. It's all about the dollar.
Exactly, because there's no one really flying out of the market here like you and I just talked about.
Well, Ryan, we did see that Raytheon, the maker of those Tomahawk missiles, the shares did pretty well today. Which other sectors do you think are going to react positively to these tensions?
Well, I think oil. I think oil prices potentially are going to keep rising here, even with more production in the U.S. The reality of it is supply and demand. Well, demand's going to really outpace supply over the next couple of years, especially by 2020. So I think anything energy related is probably a really good long-term buy here.
Jobs. The jobs report, very disappointing. Missing by quite a bit. 98,000 jobs were added last month. Economists anticipating a gain of 180,000. What happened?
Well, I think it's just a reminder that the economy is growing, but it's still growing slowly. And I think that's good, too, because it's going to keep inflation in check. And it also, if you look at the treasury yields right now, interest rates aren't going to dramatically rise here. In fact, they've come back a lot this year from the massive rise they had at the end of last year. So it's just a reminder we have a healthy economy, but we have a slow-growing economy.
So what does that mean for the Fed and Fed action?
I think they're going to, like they said before, they're going to be slow to raise rates. You may see 2 more hikes this year, but I just don't think you're going to see inflation skyrocket, which means they're going to be very tame with the way they move interest rates up.
Now, Ryan, last night, whilst this missile strike was taking place, President Trump was having dinner with China's President Xi Jinping.
Yes.
Investors were watching that meeting quite closely because of concerns about potential trade wars or what it could mean for U.S. and Chinese economic relations. Now, the president said that things went well, that they made progress.
Yes.
But what did we get out of those talks? Any clarity?
I don't think we had a lot of clarity, but they did say that they were willing to work on the deficit, and I think that's critical. I think seeing the dollar weaken is a very good thing for our net exports, because that means our goods are cheaper to everybody else. And if China's willing to play ball on that, I think there's a very good chance that we're going to see our deficit cut while the Trump administration is in power.
So how would that deficit cut take place?
I think it's going to be a weakening currency, because you have to remember on the other side of the pond there, in China, basically, they've had a lot of money fleeing the country.
Right.
So they're going to have to raise interest rates to make it more attractive to keep the money in there, which also means their currency most likely is going to have to rise. So I think they're at a point now where they're going to see a rising currency, and they need it to rise to keep capital in the country.
All right. Thank you so much, Ryan Payne. Thanks for being with us.